Alright, what is good YouTube? Welcome back to another video. Today we are going to be going over liquidity and fair value gaps. Now obviously if you already know ICT concepts, you do not have to watch this video, although there is probably some gain you can get from it because everyone explains the concepts their own way, and that is what I'm going to be doing today, explaining my own rendition of them. And this is going to be a series which will be slowly building up how I trade my strategy, and then after all that we will get into psychology and some of the things I struggled towards before getting consistent with the strategy and how I used it to trade prop firms. So let's get right into this video. Okay, so getting right into this is going to be liquidity and fair value gaps. Now I have them in the same series video because they are kind of the same thing. It is just the difference between internal liquidity and external liquidity. All right, so let's get right into internal liquidity. Now, we have 3 bullish candles right here and 3 bearish candles right here. Now, if you've ever traded patterns before, you understand these as like, I don't even know what they call them, like 3 marching men or some bullshit. But yeah, this is sort of the same thing. It means that we are seeing more bullish traders, more bullish action than bearish, or more bearish action than bullish, and we expect a reaction out of this area. So how can you mark out fair value gaps on your chart? This is how right here. So bam, you just mark it between the 2 wicks and keep this middle spot as your fair value gap. Same thing for the bearish. Bang. So ideally, this is where we want to see price react out of and continue down into our target and get a trade out of it. It's really that simple. All right, now that we have that established, and we will find these on the charts here soon, I want to get into the external, or just liquidity in general. And that is just going to be resting below old lows and old highs. Obviously, everywhere on this chart will have liquidity. It's just that some of it means more than the other, right? So we have liquidity on all these lows, liquidity on all these highs, and it all eventually gets hit. It all eventually has to get, taken. That is the nice thing about liquidity, is we know for a fact that is how the market moves. So this isn't some sort of bullshit ICT concept. It is just liquidity. Not that hard to understand. So below these lows, we are going to find sell stops, and below and above these highs, we're going to find buy stops. Simple, simple, simple stuff. All right, now how can we use liquidity to our advantage? These are going to be our targets. So when you're on the higher time frame, which my strategy revolves pretty much around the higher time frame completely, so you will be using the higher time frame to find out what direction we're going to be going, and if that direction is not clear, then you do not want to be taking a trade towards it. Simple, simple, simple stuff. And yeah, that's pretty much it there. All right, welcome to the charts now, where we're going to look at fair value gaps, how you can mark them out, which ones are going to be the best ones to look at. So first of all, as you can see, there is plenty of fair value gaps to mark out. Bam, bam, bam. You want another one? Here you go. Bang. More? You want more? Oh, I got you. Don't worry. Bang. Another one. Bang. All right, I'm going to stop doing that. All right, so as you can see, there is pretty much infinite fair value gaps on your chart. Now, first of all, you do not want to be marking out every single fair value gap. That is not healthy, and you will end up overanalyzing the shit out of the market and just end up with a losing trade. So what fair value gaps do you want to mark out? Well, first of all, you have to compare the volume of your fair value gap to other ones in the area. So something like this that I marked out here is a good example, because as you can see, all these other little bearish fair value gaps that we made, these really tiny ones, right? Something like this right here. I'm gonna go zoom in hella. Like, you see this little fair value gap. Now obviously we aren't respecting this fair value gap at all, because it's not anything close to some of the bullish ones that we're making here. These should not make much of a reaction compared to the volume of some of these other fair value gaps that we have in the area. All right, perfect. Now that you understand that the size actually does matter in this world, it sucks, man. I know it really sucks, but size does matter, especially with fair value gaps. It really does suck. But this is what you want to look at. See this fair value gap right here? This one has a bunch of displacement. It is made up in a quick move. There's not really any chop around this fair value gap, and we wick in this fair value gap and wick out completely in one candle. Like, this is something high quality. This is fast moving. This is something I would take a trade off of because it is displacing. It's bigger than all the other gaps, and we have external liquidity above. Look at all this. Bang, I can mark this out all day, you know. Now, since I am marking these out right now, I'm going to introduce you to sort of a sub-variety of liquidity, and that is going to be LRL. What this means, low resistance liquidity. Now, this is basically just sort of a trend line type movement. Bang, 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 bang. So, LRL, or low resistance liquidity, is something like this. So, it's a trend line looking movement. Now, god damn it. I don't know why I keep doing that to my chart, but it is basically just built up liquidity on one side of the chart, one side of the market, you know. So right here we have only buy side. Buy side meaning there's only buy stops. Now, as you can see, all of the sell side has already been getting swept because we're in a down trend, and all of the buy side is still resting up here. So up here is a shit ton of liquidity. All up here is a shit ton of liquidity, and you can expect this to get ran in a very quick move. This will happen all the time, right? So now that we see we have LRL, we have a big fair value gap that we made, and then we react out of the fair value gap. This is something high quality. This is something that we want to have marked, and this is something we'd want to take a trade off of, you know, something like this. Marking this high, that is a very simple, easy trade. You know, so that is how you would use a bullish fair value gap to your advantage. Not exactly teaching you a strategy yet, but that is how you'd mark it out. That is the conditions I would use it in. And now let's look at a bearish fair value gap. All right, now I'm just going to mark out this 1 hour right here, even though this would be more of a 4 hour gap if we looked closer. But as you can see, we tick into this 1 hour gap and instantly react from it, closing below a fair value gap. Disrespecting this fair value gap, meaning we're probably going to move lower. And as you can see, we make more bearish displacement on the way down. Bang, we can mark up fair value gaps all day, but it's all about the story that it kind of leaves behind. That is super cliche. Actually, that is super corny. I'm not going to lie, but it really does kind of line up like a story. You can kind of just read it, you know, how we react, what liquidity we take based on, you know, you can use that to find out where we're going to move in the future. So there you go. That is how you mark bearish fair value gaps like that. Now let's look at external liquidity. Let me find a good example. All right, here we go. So we have a prominent high. Bang, we spike up, spike down. Get rid of that. So this is buy side liquidity. And what do we do when we come back up to this point? We move up quickly, react out of it, and instantly reject from it. So now we have swept the liquidity, right? Bam, sweep of high time frame liquidity. Expect some sort of reaction / reversal. Now this is all going to be important in the future because you are going to use all these not to take a trade, but you are going to use the high time frame reversal and the high time frame sweep of liquidity to find out where we are likely to move next. If I saw just this right here, I would think, okay, we don't really have any targets above. We only have this point of liquidity. We have these 2 points of low resistance liquidity, as in we don't have any fair value gaps on this time frame stopping us from taking these. This is what I would call our next draw, you know. As of now, my bias is pointed towards the downside. I'm more bearish because we have no targets above and we have targets below. So that is how we are going to use those to find our bias. Now, I haven't done a bias video yet, but that is how you're going to mark out buy side and sell side. So, sell side would be something like this. Bang, we take sell side, but again, there's still sell side below. Obviously, we edge this sell side right here, but I'm going to get more into why this happens and why it actually makes sense, okay? Do not worry about this yet, but that is how you mark them out, basically above old highs and lows, and again, fair value gaps. 3 candle formation from the wicks. That is how we're going to use these to find high time frame and low time frame entries and the right conditions to trade in. So hopefully you enjoyed the video, and I will be posting daily on new strategies and all that. Not new strategies, just the new strategy videos, the new series, whatever, daily, hopefully. So hopefully I'll be able to stick to that. We'll see if I can. I will stick to that. I will stick to that. All right, but hopefully you guys enjoyed. Make sure you join the Discord down below if you have not already. Literally everything in there is free. I'm not going to charge you for anything, So join that up. I'm giving free commentary, and I will hop in a call with you for completely free. So, all right, hopefully you guys enjoyed. Peace out.